8:59 and counting down. We're getting ready to get started here. All right, let's see how I'm looking on this thing today. And where is it? Here we are. All right, I'm looking pretty good. Not bad. Stream is going steady. Gotta love that. All right, let's jump back over and get started. Oh, wrong one. Here we are, right here. Oh, hey. Get down. This is always fun. All right, everyone. How are we doing tonight? You have to excuse my voice. I'm a little hoarse. I got this virus I caught from my son. How nice of him. 28 years old, and I'm catching a virus from my son. Anyway, 9 o'clock p.m. Tuesday, January 3rd, 2017. This is the first show of the year, and we're getting a little bit better at this, so hopefully this is going to go nice and smooth. I'm going to try to keep this short as possible. I'm trying to save stress on my throat because I don't want to be talking like, I don't know, Boris Karloff tomorrow. I don't know if that's good or bad. Anyway, like I said, it's the January 3rd, it's 9 o'clock. We're here doing our dividend investing. I don't know if you guys have been following me from last year. Everything's got reset to this year, so I'm going to give you a quick rundown on what our performance was for last year. Now, I trade two different accounts, and I trade 2 or 3 different strategies. The main strategy we're trying to teach everyone is dividend investing. That's where we're investing in a dividend stock just before the EX date. Now, the reason for this, historically speaking, that means how everything plays out year after year after year. These dividend stocks that we're looking at have a tendency to move in the direction that we're looking for in order for us to gain a very small amount of money in a very safe manner. Now, what I mean by this is you have your money and you want to have it invested. You want to have it invested in a safe, secure investment. Now, what better way than to invest in companies like Xerox, Caterpillar, oh my goodness, I'm drawing a blank, Walmart, Microsoft, Apple, companies that have been around for years, AT&T. Anyway, we want to look at good, strong, solid companies that you wouldn't mind buying and keeping, specifically to capture the dividends, to give you a monthly or quarterly return for your money. Now, what we're going to do with those, instead of buying them and holding them, we're going to trade them, kind of like a day stock. Okay? Now, the idea is to capture as many dividends as you possibly can, safely. Grab a dividend, get out. Grab a dividend, get out. All right? It's small bites here, small bites there. It allows you to safely increase the return on your investment. Now, you may not think of a dividend as being a lot of money. It's really not. It's a small amount. Anywhere between a 1 or 2% return. However, if that's a 1 or 2% return once or twice a week, that by the end of the year turns out to be a lot of money. Point being, now, like I said, I manage 2 different accounts. One, mainly dividend investing. That one averaged last year 26% return. That's not bad. And it's all safe dividend companies. Now, at the end of the year, which was just the other day, I ended up with 3 companies left, which we carried over into the new year. Okay, I'm going to get rid of those things first thing in the morning so we can start fresh at ground zero again, and we can find out how we're going to perform this year. Now, the other account I trade has a lot to do with options. Now, some of you may not understand options, and that's fine. Options give you more options, for lack of better words, or more ways of making additional money safely. See if I can give you an example. Let's say you like IBM, and you want to buy IBM, and you want to buy and hold IBM. Great, fine. There's a way of selling an option for someone to help you reduce the cost of purchasing that stock. Or, better yet, you can buy the stock, sell an option, and then sell the stock for the exact same amount of money you paid for it. Yet, what good is that? Well, let me tell you. You get to collect what is called a premium. So if you buy IBM for, let's say, $100, and you sell, let's say, John, an option for him to buy it from you for the exact same amount of money you paid for it, then you collect a premium. And if everything works out right, John buys the stock from you from the exact same amount of money you paid for it. Why do that? Because you're capturing 1 or 2% per week. Sometimes even more than that. Now, 1 or 2% a week doesn't sound like a lot of money, but add it up and think. There's 52 weeks in the year. 1% a week comes to well over 50% per year. And you're doing it on companies that you really don't mind holding. Okay? All right, so with that said, let's take a look at what we're looking at. Today, like I said, it's January 3rd. Okay? There was 12 companies that paid out a dividend, or that went EX today. Today was the EX. Today was the last day of trading before they pay out the dividend. All right? Well, actually, no, they paid out the dividend today. So the last day of trading, which would have been yesterday, but not really yesterday, it would have been sometime last week, the last trading day. All right, so in order to capture the dividend on any one of these stocks that went EX today, now let's take a look at some of these. ABM, don't know them. BRX, CLI, DOC, ERE, HT, Oracle, everybody knows who Oracle is, RCI. We could just take a look at this way. All right, BRX is the Brixmor Properties Group. ABM Industries, never even heard of them. Oops. Let's go back up to here and get rid of that. Okay, DOC is Physicians Realty Trust. ERI is Erie Indemnity Corporation. HT is the Hersha Hospitality Trust. Oracle, we know who those are. RCII is Rent-A-Center. Okay, you probably all heard of Rent-A-Center. I don't know. SDD is Simpson Manufacturing. SUP, Superior Industries International. Village Supermarket. I don't know, never heard of them, never shopped there, but they're offering a dividend. And WNC is Wabash National Corporation. No idea who they are. They're offering a 6-cent dividend. Not a lot. Strictly speaking, I stay away from dividends that are less than 10 cents. Only because they have to be a really low price stock in order for me to get a good return. And 6 cents is not a lot of money to chase. Okay, so let's take a look at the numbers. Okay, if we were going to buy one of these companies, we wanted to get in the last trading day, which is the third. 10 days prior from today would have been 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. December 16th. Okay, so let's take a look at ABM December 16th. The 16th. Okay. Here's the 16th here. I'm going to be moving the cursor around and telling you numbers. Here's where you are going to have to look. Right where the cursor is now, that's the opening of the day. Here is the high of the day, this is the low of the day, and this is the close of the day. All the rest of the stuff is really irrelevant. You don't really need to know. Okay, so ABM has a 17-cent dividend. If you wanted to capture that 17 cents and you got in on the 16th of December, the stock opened up at $39.73. So 17 cents on $39.73 is less than $40. High of the day is $40.32. Okay, now if you had what's called a stop loss or trailing stop, that's the word I'm looking for. If you had a trailing stop, you could have captured that whole amount of money. You get in first thing in the morning. Now, I say get in the first thing in the morning because I like to do all my trades the day before. That's like tonight being the 3rd. I will jump in tomorrow morning, first thing, at the market open. So I will actually put my trades on tonight. I'm actually going to do 1 or 2 because it's the beginning of the year and I have all this money to spend, all this money to invest, I should say. So I'm going to do 1 or 2 tonight so you guys can see how I do it, and then you guys can follow along with whatever you... Now, don't do what I do. Make up your own mind, make up your own decision. I'm just going to show you what I do and how I do it. Okay, so first, ABM, the 17-cent dividend, as we can see on the opening of the day, it was $39.73. She jumped to $40.32. Okay, that's a great number. Love it. Okay, now if you held on to it with that trailing stop, You could even jumped up to here, here, and here, and you get stopped out. You probably would have got stopped out here because of the big dip, all right? Because the low was at the 39.82, and it opened up at 40.43. That's a big space. Now, coming up with a trailing stop, you have to figure out how much wiggle room you're going to give the stock in order to make it move. Because all stocks move every day. Now, I'm going to show you something that I have on one of my pieces of software that might help you out. Now, once you become a member of our group and a paid subscriber, you're going to get this in your mailbox. And I'm actually going to start sending this software out to people who are members. What the software is going to do is you put the stock symbols into the software, and it's going to tell you a bunch of information that I found that was important for me when I was doing my first time my investing in this type of strategy. The stock symbol, the price, the dividend, the yield, the 20 MA. That is the 20-day moving average. That's not your average moving average. That's not what everybody else is looking for. I wanted a different number to look at. I wanted specifically. Now I'm going to go back to the other screen to show you what exactly I was looking for. I wanted the exact number, the difference between the opening and the high and low of the day. So the high of the day for this one right here was 40.32. The low was 30.47. Now that's a nice little spread between, that's almost a dollar spread. Yeah, about a dollar spread, close to a dollar spread. Okay, but what does it do on an average? Okay, so this day right here is the difference between 40.32 and 39.47. Here, the high was 40.75, low was 39.82. And here, the high was 41.14, the low was 40.20. You take that spread between the high of the day and the low of the day, subtract it from the opening of the day, and it gives you an idea of how much that stock moved in relationship to the opening of the day, percentage-wise. And that's where I came up with these numbers. That's what the 20-day moving average. Okay, so these numbers here, these percentages, are how much the stock moved in direct relationship to the opening price. Okay, so 1.9% of $34. What's 1.9% of $34? Well, 1% of $34 is 34 cents. Okay, so that's almost 2%. So 2% is 68 cents. So 1.9 is probably somewhere around 64 cents. Okay, so you have a $34 stock, and it moves an average over the last 20 trading days. That's what the 20 MA stands for, the last 20 trading days, which there's no Saturdays and Sundays in the trading days, so that's basically a whole month. That's 4 weeks, a whole month. How much does the stock move on average for the whole month? So average of 1.9% on a $34 stock, it's about 60 cents. Give or take a penny or two. Okay, so if I'm going to use a trailing stop, I want to get in at the opening, and I want to be able to give it enough wiggle room. So if it only moves 60 cents a day, I don't want to give it a wiggle room of $1 because that's way too much. And I don't want to give it a wiggle room of a whole 60 cents because that's the whole range. So I usually like to pay 60% of the moving average. So if the moving average for this company is 60 cents, 60% of 60 cents is roughly right around 36 cents. Okay, so I give it the wiggle room of 36 cents for this price stock because it moves, on average 1.9. And then you can decide if you want that tighter or if you want it bigger. So where you get in, where you get out is going to be totally dependent upon what numbers are okay for you. Okay, so let's get back to where we were. All right, and we were here. All right, so if you're just looking to grab that 17 cents, you would have been in and out relatively quickly. She opened up at 39.73, and she hit a high of 40.32. Now, to be honest with you, the fastest trade I ever made was 6 seconds. The stock opened up, and then within 6 seconds, I was out and I had my profit. Okay, now how do I do that? I don't really do that. Okay, it's all automated. Okay, sometimes it's fast, sometimes it's slow. I held on to one stock for 2.5 years. I got 3% yield on the dividend every 90 days, but I really didn't want to hold on to it for 2.5 years. But I did anyway because I didn't want to lose any money. Anyway, okay, let's do BRX. BRX is looking for 26 cents. And we're going back to the 16th, 15th, 16th. Okay, so we're looking at 26 cents. It opened up at 24.30. 26 cents on top of 24.30 would be 24.56. Okay, so she hit a high of 24.43. Very next day, you would have been out. Okay, she opened up at, actually, you would have been out at the opening the very next day. Okay, because your opening for the 16th was 24.30. So you add the 26 cents onto the 24.30, and you come up with 24.56. Okay, so that's your new exit point if you're just looking for the dividend. Okay, if you look for the dividend plus a little bit extra using the trailing stop, that's totally up to you. Okay, so it opened up the very next day at 26.62, which is over and above your exit point. So you would have been out the opening of the second day. Okay, CLI. On the 16th. Ooh, we got to do a doji on the 16th. Now we all know what that is, right? Where it opens and closes at the same amount. Okay. Anyway, 15 cents on CLI. It opened up at 27.92. 15 cents on that. 27 would be 28.17. Is that right? No, 28.07. 28.07, I believe. Yeah, 28.07. Yep, so you're out the very same day. Okay, opened up at 27.92. The high was 28.21. So you're at your 15 cents the very first day. And again, if you did the trailing stop, look how far the drop came. Okay, from the low of the day was 27.55, which is like 40 some odd cents below the opening. So if you did use a trailing stop, you would have been stopped out. Now, trailing stop, sometimes you can lose money on a trailing stop. Because once you hit the target price you're looking at, and that trailing stop, and the baby backtracks a little bit, boom, you're out, and you could lose. So that's why you got to be careful on what you choose. You want to choose a stop, you want to choose a stop loss, you want to choose a trailing stop. All depends on what you're looking at. All right, so that's 3 of them down so far. 3 of them. 3 for 3. I like 3 for 3. That's a good thing. We're going to go a couple more because I want to save my voice. I want to jump up to what we're going to be doing in the near future. So 16th, 12/16, right? 12/16. And no, I'm not just picking this date out of the hat. 12/16 is 10 days prior to today. Okay? Here's the dividend. Okay, you want to be out the day of the EX dividend date, which is today, 1/3/17, right here. EX dividend date, 1/3. 10 trading days prior to. So you want to be out by this day. 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. That's where you want to get in. 10 days prior to the EX date. All right, that's that. We don't even have to go through this exercise. We can look at 22 cents is right there. It opened up at 18.25. The high was 18.46. Next day, she opens up at 18.63, and the high was 19.09. 22 cents already built in there. Now, I'm not going to go through the rest of them because you can basically see where we're going, okay? The first 4 gives you a good idea of how most of these are going to perform. Do we really have to look at them all? Okay, so let's look at this for tomorrow. Okay, if you want to get in on any of these companies, you would have had to have bought them today, which means you would have gotten the list of these companies not on the 16th, but on the 17th, which is 10 trading days prior to today. Okay, so prior to tomorrow. Okay, so tomorrow would be the next day here. So this is 10, 9, 8, 7, 6, 5, 4, 3, 2, 1 on the 17th. Okay, now some of these you've heard of. RGLY, that's a gold company. SYY, that's Cisco. AXP, that's American Express, I believe. Whoops. American Express. Yep, American Express. Kroger. Oh, Kite Realty. Kite Realty Trust. Never heard of them. There, I did it again. Makes me think about Britney Spears. Ooh, I did it again. Okay. Monsanto, Cisco, BMY. That's Morningstar, isn't it? Yeah, Morningstar. You got a dividend of 23 cents. Oh, JP Morgan. 48 cents. All right. Anyway, those are for the guys that are going EX tomorrow. All right. So that's them. If we're going to do some trades, we're going to look at 10 days prior to tomorrow. So tomorrow is the 4th. So if we're getting into anything tomorrow, which is 10 days, which would be the 18th of January. Now, the 18th of January has 9 companies to look at. Okay? Now, I already went through earlier and I installed all of these companies into the software, into one of my software. So as a member of the 10-Minute Trader, you get access to the software. You get this software here, which is on the members page, and you get this software here, which is on the members page. Now, like I said, I already installed all 9 of those companies. So let's take a quick look and see what they look like. Whoops, too small. Right there, that looks good. And let me explain to you what we're looking at here. Okay, the very top line we're looking at is the stock symbol, the 50, 75, 100 that represents the valuation of the dividend. So if the dividend is 25 cents, right here, see that 25-cent dividend. This is 50% of that dividend, which is $12. Which is 12.5 cents. 75% is 75%, and then 100 is 100% of that. So as you look at it right away, what do you see? The very first one, APA. Look at this, all ones. Within the very first day, you're going, historically speaking, the very first day, you were in and out in profit within the very first day. That's what I like looking at. I like to see ones across the board. Okay. Now, I'm going to explain to you some of these numbers, and I'm going to tell you what I like and what I dislike about this one. APA, I don't really know who they are. Do I really care? No. What I care about is a few things. Number one, they have historical performance, okay? They have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 years worth of data. It allows me to see how they have performed over the last 10 years. Every single time over the last 10 years, on the very first day, I get in 10 days prior to the EX date. I make my target as the opening price plus whatever the dividend is, and then I get back out again. I want to be in and out the very same day. Granted, 25 cents is not a lot of money, but you get 25 cents or 1,000 shares or 10,000 shares, it adds up pretty quick. Okay, so now, APA, those numbers look good. All ones, those are great. The closing price today was $63.47. The high for the year, the last 52 weeks, was $69. Okay, that's not bad. The low was $32. All right, that's not bad either. Now they have a 1-year target of 64.16. Now that's not too bad. They expect it to go a little bit higher than what it is now. Now they're paying a dividend of 25 cents, and that's great. Now here's the part that I don't like. Okay? If I buy it and hold on to it, that 25 cents only represents 1.58%. Okay. If I buy it on margin, you can double that to 3.16%. Now, I'm not going to tell you to buy stuff on margin. This is a decision you have to make on your own. Margin allows you to borrow money from the house. So you're using your money and you're using some of their money. So if you are going to do that, yes, you'll double your return. However, you also double the risk. Okay, double the risk, double the reward. So it's a very touchy subject for some people. Some people got burned. I personally got burned in the past using margin money. That's when I was young and arrogant and I thought I knew everything. Younger days. Anyway, so this one I may or may not do. Okay, so all these numbers so far, they look good except for this one here. Now, I might do this one depending on a few other things. Now, let's go check on what those other things are. I'm going to click on this chart button here. That's going to take me right over to Yahoo Finance, and that's going to show me 10 years worth of stock data using a stock chart. All right, so APA, Apache Corporation. Okay, she closed at 63.78. Now, down here you see the little D's. Those are all the dividends that they paid, and they look very nice. I like that with nice even amounts of dividends. These little lines in the back that you see, you can't really see them very well. A little shaded red. Those are down days. Green's up days. That represents the volume. Okay, now here you get a volume spike on a down day. Here's a volume spike on an up day. Okay, irrelevant. It's not really drastic information. This is what I want you to look at. On the far right represents the price closing today, 63.78. Now, on the very far left represents where the stock was 10 years ago. Okay, so 10 years ago today, this stock was at 68.46. Okay, as you can see, it had some highs, had some lows. Highs, lows, highs, lows. This is what you call a sideways stock. I mean, granted, there's some highs and some lows, but basically going sideways, staying in within the range of, 39 and $100. That's a big range, but still, looks like it's going sideways. Okay, so to make it short, I don't like it. I wouldn't do it. Sorry, that's just my opinion. I'm going to run over quick to Yahoo and see if YouTube, see if we have any questions from anyone. No, not yet. Great. Makes my life a little easier. Okay, so as I said, I wouldn't do this one only because it's going sideways and it was higher 10 years ago than it is today. I don't want to buy something and have it worth less money 10 years from now. Okay, so let's get out of APA. We don't like them. We don't like APA at all. And we want to go, the next one, Caterpillar. Now, Caterpillar is a very well-known company, all right? It's a household name for a lot of parts of the world. Now, I'm a little concerned about a couple of things, okay? So it makes me leery on whether or not I want to do Caterpillar. 2013, they didn't pay a dividend. 2015 didn't reach a full 77 cents of the dividend, okay? And 2016 took 41 days for it to reach that. Okay, so those right there don't make me a happy camper. Here's where else it doesn't make me a happy camper. The close for today was 92.74. The high for the year was 97.40. Okay, the low was 56. They have a 1-year target of 87.89. Okay, they're paying a 77 cent dividend, and it's a 3.32% yield. If I decide to buy it and hold it. But did you just hear what I said? Buying at 92 and they have a 1-year target of 87? Right away, no thanks. I'm not even going to look at the chart because I don't like it. CPTA, look at this. 2 years worth of data? No thanks. All right. ECOL, missing data here. 32 days. That's over a month. Okay, 49. And it's got a 1-year target of 44. No thanks. GD is that I forget who GD is. They didn't pay out a dividend in 2013. Look at this. That's only 3 months. 2016 took them 3 months to hit a 76 cent yield. Have 76 cent dividend. No thanks. And if I buy it, it's 1.76% yield. No thanks. All right. Ozark, OZRK. I believe this is Ozark Bank. I'm not sure. All right, so they had an average of 1.2 days. I can deal with that. Okay, I like those numbers. It closed at 52.59, not bad. High of 54.92, not bad. The low of 33.51. Okay, nice range. A 1-year target of $57, not bad. 16 cent dividend. All right, 1.25% yield. I don't really like it. However, I like to be in and out within 2 days. 16 cents for 2 days. Let's hold on to it for a bit. Check out the chart. See what that says. That's going to give me a better idea of what can I expect if I have to hold it. Is it going to trend up? Now that looks beautiful. This is what you want to see when you see a chart, a 10-year chart. 10 years ago, this baby was at $7.18, and look where she is now, $57.92. I like it, even though it has a low yield. What was that software? All right. Even though it has a low yield of 1.25, I don't mind it because the software says that's what it looks like. And look what the chart says. 10 years ago, it was at $7. Now it's at 52. That gives me a good indication, a warm, fuzzy feeling to, hey, another 10 years, this baby could continue to go. Is it going to? I don't know. You don't know. Nobody knows. But we base our decisions on what it's done in the past. In the past, it was $7. Now it's 52. I like that. So that one, I will do Ozark. So we're going to do that one in a little bit. All right, we're going to do Ozark. Now let's PKI. Okay, these numbers don't look that bad. An average of 2 days, 1.78, not bad. All right, closed at 52. The high-low, nice range. It had a one-year target of 54. All right, now here, number one, I don't like the dividends below 10 cents, so no thanks. And look at the yield, 0.5%. No thanks, sorry. And this is where I feel bad, because I really do. Because the people working at PKI, they may be the greatest people in the world. I don't know. Okay? I feel bad about saying, no, thank you. All right. WDFC. They're missing a dividend from 2015. Makes me a little uncomfortable. Here's how the other numbers make me look uncomfortable also. It closed at 116. The high was 125. The low was 94. Those numbers I can deal with. Here's where I'm comfortable. 115 for a target. That's lower than it is today. No. Dividend. I like the dividend. Okay. The yield, 1.6. No. Look at this one. 97,000 shares on a daily basis. What are you, the only one on the dance floor? No, thank you. I'm not even going to look at the chart. Okay. ZTS. Nope. Not even going to look at 3 years worth of data in the first year that didn't even hit their target. No, thanks. So I'm down to 2, APA and Ozark. Okay. Both charts look good. All the numbers look good. Everything except for the yield. We don't like the yield. But hey, I can deal with it because they both look good in the long run. All right. We're going to look at OZRK. This is the other piece of software we're looking at. OZRK. And its yield dividend was, it's the 3rd to 17th. All right. You just need to come in the average of that area. Then you plot the dividend and see what it looks like. All right. So let's scooch down a little bit. Click on the average because we don't want that. There we go. All right, so the way this chart looks, based on the average performance over the last 10 years, if I get in on the very first day with Ozark, we're looking at, number one, the other chart, the other software said we're looking to get in and out within the first day. Great. All right, we get in, we get out very first day, no problem. All right, so if I buy it 10 days prior to, we look like the stock value could go down between now and the dividend date. After that, she goes up a little bit, sideways, and then continues going up. Okay, so historically speaking, the stock moves an upward trend after the dividend. So it's a good indication that we can collect our dividend and then get back out and then jump into another company. So this software, it's not as great as I'd like to see it, but this one here is, so I'm going to do this one, and let's quickly look at it, and I'm going to get off very shortly, save my throat. Now we're going to do OZRK, right? Yeah. OZRK. Okay, this is what it looked like for the year. Now, I'm going to point out something to you, because this is let me think. This is not really interesting. This is like a historic, okay? I say that only because every once in a while you're going to look at a chart. You look at a whole bunch of charts, and there will be a certain date that stands out over and above everything. Now, everybody knows when you look at like a 10-year chart or a 5-year chart, let's say a 10-year chart, 2008, 2009 is going to show up for the low of the year. Why? Because we had the big meltdown back in 2008. That is a pivotal point where it stands out so high, and every single stock has it. Well, I should say almost every single stock has it. It's a pivotal point. Here is another one. Look at this stock from up here in January 4th of last year. A slow downtrend up into February, the first, second week in February. It goes up a little bit. She goes sideways for a little bit, then down again. Look at this, these down days. Hold on, like almost a month and a half of down days. Then she goes sideways for the whole summer into the fall. And look what happens right here. I'm going to highlight this area. Okay, October. She goes sideways, sideways, sideways. And then she comes into November. And what happens on November 8th? Donald Trump gets elected. What happens to this company? Look, the very next day, a nice up day. She went from 37.15 to 39.55. Next day, 42.85. Next day, 44.41. And then slowly up all month long to November. And she's settling somewhere right around here, 52.74 from 35. So 35 to 52, that's a big jump within 2 months. And it's all because of the election in 08. So you're going to look at 11/8. So that's November 8th. So you're going to look at a lot of stocks, and it's almost going to be a 50-50 split. From November 8th, they're either going to go up, or November 8th, they're going to go down. And it's the strangest thing. But it's a pivotal point, just like in 08 was a pivotal point for the meltdown of the financial market. All right, so Ozark is the one we're going to look at. Be the first trade of the year. Yay! All right, so come on. OZRK. Now, this is something interesting you're going to see is the close of the day, or the last trade of the day, was 52.91. So, why is the bid and the ask like this? Sell it is 52.40, buy it is 59.57. That's a huge spread. Huge. What we're going to do is we're just going to buy it, and we're going to go to buy custom. Why buy custom? Because I already set it up to get me in and out. So that, click on that, 100 shares, Ozark, at the market for the day. So as soon as it opens up first thing in the morning, I'm in. The second trade, and I'm doing these basically the exact same time. This is a sell order for the exact same amount, triggered by percentage of 2.5%. That's that dividend on steroids that you may or may not have seen one of the videos on what that represents. Over the years, I figured out 2.5% is a good number to look at. Well, that usually works out very well. Okay, so I'm not going to do 100 shares. I'm actually going to get my trusty calculator out. My trusty calculator. Here we go. Now we're going to do a nice number of, let's say, 50,000. And what was that stock price? Stock price was... All right, I'm going to go by the last trade. The last trade was 52.91. So we need 52.91. All right, so 50,000 divide 52.91. And we're going to buy roughly 950 shares. Okay, now this company has options, so I'm going to bump it up to 1,000, which is 10 contracts. Okay. Okay, so we're going to go from 1,000 and 1,000. Okay, hit confirm and send. Okay, so here's the order right here. Buy 1,000 Ozark at the market to open. Okay, order number 2, sell 1,000 Ozark, triggered at 2.5%, limit order, good till cancel, extended, triggered by number 1. How much is it going to cost me? Right around $52,000. But it's going to be bought on margin, so it's only around $26,000. Okay, so let's send. And there you go. That's my order for tomorrow. Okay, buy, sell. So there's the spread I'm looking at. I'm looking to buy here, 52.90, and I'm looking to sell here. Is it going to hit it? I don't know. Okay, now let's go back here for a second. Hold on. All right, now this is a different setup here. Basically the exact same thing. I want to buy 1,000, sell 1,000, Ozark, triggered by right here. I want to put in how much of a dividend am I going to look for. So how much is Ozark paying? Ozark is paying 17 cents. So let's go back up to that. Okay, and I want to click on that, get that out of there, and click that. Now, let's see what it looks like. We're going to buy Ozark, 1,000 shares of Ozark, market at the open. So as soon as the market opens tomorrow at 9:30, at 9:30 in 1 second or 2 seconds, I'm going to own 1,000 shares of Ozark. Then immediately after I do that, the sell order kicks in. Sell 1,000 Ozark, triggered plus 17 cents. Limit order good till canceled, triggered by number 1. So whatever the number 1, this order, whatever this buy order fills at, it's going to automatically fill this one as a sell order plus the 17 cents. All automatically. So I'm in and now out. I can be out as quick as 5 or 10 seconds. Okay, the fastest trade I've ever made was 6 seconds long. It was great. I made it, but what, $1,000 in 6 seconds? Great. Does it always work out that way? No, hardly ever works out that way. But very often am I in and out on the very same day. That's what I'm looking to do. In, out, very same day. And apparently I only have $15,000 to spend, so I can't do 1,000 shares because they're looking at 26,000 for that one. Okay, so basically that's it. Cause I hit send and it's going to pop up saying sorry, KFC rejected, can't do that one. That's all that says. Anyway, I got my order in for tomorrow, like 1,000 shares. That's what we're looking at for tomorrow. You have all these companies here paying a dividend in 10 days from today, or actually 10 days from tomorrow. And only one of them actually looked good enough for me to do, which was the Ozark. You guys decide what you guys want to do. Caterpillar, don't get me wrong, it's a great company. It really is. You might want to buy it and just do that, but it was missing a few pieces of data for me. All right, with that, I'm going to try one more time, see if we have any questions. And where are we with questions? Here we go. Get out of there. And we have no questions. Outstanding. Anyway, so this is James. I'm going to be checking out and hopefully catch you guys next time on Thursday. This coming up Thursday, we're going to talk about options and see how well those work. So this is James signing out. You guys have a great day.